I think you should pay a lot more tax today to pay even less over the rest of your life. Here's the thing. We need to stop thinking about last year's taxes and start thinking about lifetime taxes. Now, when it comes to today's video, we're gonna talk about tax planning. We're gonna specifically talk about someone that has all of their money inside of pre-taxed accounts like their 401k or their IRA. So as we dive in today, what I want you to know is that this example that I'm gonna walk through is something that I see a lot of, but it's just an example. So we're gonna be 60 years old, we're gonna be retired, all right? And our income is gonna look like this: 50,000 of pension and about 50,000 of Social Security. 35 for one spouse, 15 for the other spouse. Total income, $100,000 a year. And they're retired with $2 million inside of their 401k. Now, the number doesn't matter a whole lot. In this example, that's what we're gonna use. So there's a tax time bomb coming. Let's jump in and walk through what that looks like. When we look at this chart here, there's two different scenarios. There's, hey, what if we do nothing? And then there's, what if we start doing Roth conversions? All right, so the do nothing plan is the light blue lines here, okay? So you're gonna see several different lines. Those represent the tax brackets, all right? The 10, the 12, the 22, the 24, and the 32. And then the little bar graphs are the different incomes that this couple is experiencing. So you can see the light blue bar graph is pretty level. We're right in there around $100,000 a year, right underneath that green line, maxing out the 12% bracket. But then you're gonna see all of a sudden it shoots up here and goes way into the 22% bracket. Why is that? That's because when you have a 401k or an IRA and you're 60 years old today at 75, you're going to have to start taking money out of that bucket, whether you want to or not, and it could shoot you up in tax brackets. The other thing that it could also do is make your Medicare cost more, because there's this thing called an IRMAA limit or an IRMAA bracket, and that's simply if you make too much money, and you could be making too much money by artificially inflating your income with a Roth conversion, that can cause you to have to pay more in IRMAA taxes, or IRMAA surcharges, I guess is the correct way to say that. This tax planning thing is super important, and I know there's a lot of details to it. So what I've done is I put together a toolkit for you that you can grab in the description below, and that'll walk you through several different retirement planning things, but specifically there's a tax planning piece of that toolkit in there. All right, so as we can tell, we're making $100,000 a year, we're maxing out that 12% bracket. We have to worry about required minimum distributions. Now, if you're married, most likely you're not gonna pass away at the same time. So what does that mean? That could mean a loss of income, right? In this situation, we're gonna lose a Social Security. We're gonna lose 15,000 of Social Security because the bigger Social Security stays and the smaller one goes away. You'll see here at the end that all of a sudden we go from the 22 clear up to maxing out the 24 and potentially bumping into the 32% bracket when someone passes away. And the reason for that is you'll see those brackets really adjust down. When someone passes away, those tax brackets get cut in half. All right, so that is if we don't do anything. Let's go back and let's say, what if we do Roth conversions? Now, I put together a scenario that probably isn't maximizing it to a T, but we put a little effort in and we said, hey, what if we get aggressive? What if we show an aggressive Roth conversion and we don't worry so much about the tax that we're gonna pay today, and we worry more about the tax that we're gonna pay over our lifetime? Let's say max out the 24% bracket. Dark blue bar graph. You're gonna see much higher here right out of the gate, okay? Then it bumps down. That's because we ran out of money in the IRA or the Roth, in the 401k or in the IRA that we were converting to a Roth. All right, and so we're doing pretty major six-figure Roth conversions for those first several years. What does that mean? Well, a couple details we need to think about. From 60 to 63, we can max out the 24% bracket, and we don't have to worry about those IRMAA limits because Medicare is priced off of your income from 2 years ago. Medicare starts when you're 65. So as soon as you are 63 years old, your income is going to matter. And that could make your Medicare cost more. In this example, it's absolutely going to make your Medicare cost more once you hit 63. You're going to see we're going to get a couple years here before we hit 63 where we don't have to worry about it. We're just maxing out that 24% bracket. Then we're going to have several years there where we actually are going to have to pay more for our Medicare because our income is going to be artificially inflated by this Roth conversion. Now, eventually, we're going to get back down to where our taxable income is much lower, and we don't have to worry about the IRMAA limits anymore. Okay, so what does that look like? We got a couple different buckets of money, right? I'm going to call this our tax deferred bucket and our tax free bucket. And so in this bucket would be things like your IRA or your 401k. And in this bucket would be your Roth IRA, okay? We said we got $2 million in this bucket. Now, what we're thinking is lifetime taxes versus last year taxes. There's going to come a time, if we don't do anything, where required minimum distributions are going to be pretty major at 75. And we're thinking ahead on that. What can we do to make the tax burden less over the rest of our life? And that's where we start talking about moving dollars from this bucket over to this bucket. And yes, when we do that, paying taxes now. And in this scenario, we're actually going to pay some IRMAA surcharges also. What does that look like as we walk dollars from this bucket over to this bucket and pay taxes now? And what does that mean to you? Well, it can mean quite a bit, all right? In this scenario, by doing those fairly major Roth conversions, you're going to see your taxes that you're going to pay are going to be pretty major right out of the gate, and then they're going to plummet and come down very significantly. And the thing here is that's because we've converted all of the money from this bucket here, our tax deferred bucket, to this Roth, and we've paid the taxes. Well, we've done that. Now, of course, this is just an illustration. It's not necessarily exactly what you should do. If you're thinking about Roth conversions, you absolutely need to talk to your financial advisor or your CPA to make sure it's right for you, but it's definitely something that you should be looking into. All right, what I want you to take note on here is this right here, projected taxes. Now, keep in mind that's projected. There's a lot of things that can change and a lot of things that could change, but the best that we can do is make projections to kind of try to make a point and open your eyes up to what tax planning can do and if we should be doing Roth conversions or not. So base lifetime tax. So the base plan, if we don't do anything, we just take our Social Security and our pensions and we do required minimum distributions when we have to, you're going to have $1 million tax liability over the rest of your life, potentially. Obviously, that's living to specific ages, out in your 80s and 90s. Taxes staying the same, taxes could go up, all those things. There's a fair amount of variables, but the point is that's a huge number. And if we can just change that number by 30 or 40%, hey, that really moves the needle when it comes to tax planning. It turns out we can change that number by 30 or 40% because if you look at this Roth projected lifetime tax, it's down significantly by almost $400,000 less tax that you would pay by paying more tax today to pay a whole lot less over your lifetime. Now, you're going to say, that sounds really awesome, but what about Medicare? Well, here's the thing with Medicare. Here's a way that you can visualize it. You're going to see that when you turn 63, you're going to have to start paying some Medicare surcharges, okay? Those surcharges are going to add up to, over these years, from 63 to whatever that is, late 69, I guess. When we're doing those Roth conversions, you're going to end up paying an extra $22,000 in cost for your Medicare. Our base case projected surcharges for IRMAA are 0, which is awesome. Our Roth projection lifetime surcharges is $22,000. Why would we want to pay an extra $22,000 for our health care by doing Roth conversions if we could have just left it alone and our IRMAA or our healthcare costs would not have been greater? Well, the reason is because this only costs you $22,000, but your Roth conversion could potentially save you almost $400,000. So it's still a major net positive. We need to start thinking about lifetime taxes over last year taxes. Let's not get too hung up on the IRMAA thing. and trip over dollars to pick up pennies, because it could make a difference in the long run. All right, so if you're trying to figure out this tax planning thing and you've put the effort in and you're like, man, I'm just not quite sure if I'm comfortable or not, and you want to talk to somebody about it, we're happy to do that. And we can run these projections for you and say, hey, Roth conversions make sense, or they may not make sense as well. I've made videos in the past, right? I'm talking through a scenario where Roth conversions can make a lot of sense. Right here is a video that you can grab for multiple reasons why maybe a Roth conversion doesn't make sense, because there are situations where that is the case.